Welcome to The Explainer. Today, we're diving straight into the sheer massive scale of Progressive's recent financial dominance. If you've been watching the markets or tracking the insurance sector at all lately, you already know Progressive isn't just playing the game right now. They're completely rewriting the playbook. They're showing us exactly how a massive financial institution can manage to pull off aggressive growth and deliver outsized profits literally at the same time.
So let's tackle the billion-dollar question right out of the gate. How does a legacy company operating in a fiercely competitive and highly regulated sector just keep defying expectations quarter after quarter? I mean, insurance is typically seen as this slow, defensive play, right? But somehow, Progressive is posting numbers that honestly look a lot more like a high-growth tech stock.
Here's our roadmap for the explainer today. First, the Progressive powerhouse. Second, the underwriting engine. Third, strategic growth tactics. Fourth, balancing auto and property. And finally, number 5, rewarding the shareholders.
Let's kick things off with Section 1, the Progressive powerhouse. To really grasp the absolute powerhouse we're dealing with here, just look at this staggering figure. For the full year of 2025, Progressive raked in $11.31 billion in net income. And just to be super clear, we're not talking gross revenue here. That's their bottom line net income. It's a massive leap in profitability, and it's being driven by intense discipline and smartly capitalizing on a market where, quite frankly, consumers are actively shopping around.
In the wild part, they are definitely not slowing down. Look at the sheer momentum carrying into 2026. In the first quarter, they posted an earnings per share of $4.80, easily cruising past Wall Street's estimate of $4.67. They pulled in $2.8 billion in net income on over $22 billion in revenue. And if you're thinking, okay, maybe that was just a lucky quarter, well, check out their monthly report from May 2026. They hit an incredible $1.445 billion in net income for just that single month alone. That is up 36% year over year.
Moving right along to Section 2, the underwriting engine.
Now, to understand how they're doing this, we need to talk about the combined ratio. If you only take away one single concept from us today, make it this one. Because in the insurance game, keeping this number low is literally everything. It's the holy grail of profitability. It's simply the money an insurer pays out in losses and expenses divided by the premiums they earn. Over 100, you're losing money on underwriting. Under 100, you're turning a profit.
And the contrast we're seeing right now is just stark. In Q1 2026, Progressive posted a company-wide combined ratio of 86.4. That is an absurdly healthy profit margin. To put that into perspective, the broader industry average for commercial auto was sitting way up around 105 at the end of 2025. Think about that for a second. The broader market is actually losing 5 cents on every dollar of premium they write, while Progressive is over here practically printing money with plenty of room to spare.
That kind of strict discipline, it comes straight from the top. CEO Tricia Griffith makes this incredibly clear. Their overarching objective is to grow as fast as humanly possible, but, and this is a massive but, only while maintaining a combined ratio at or below 96. They simply refuse to chase growth if it means torpedoing their profitability. So, by operating at an 86.4, they are massively outperforming even their own internal targets.
Let's transition to Section 3, strategic growth tactics.
So, with their profitability locked down, how are they capturing that growth? Well, this number right here tells the story, $1.5 billion. That represents their massive Q1 2026 advertising spend. It's a huge 20% jump from the previous year. They saw that consumers were actively shopping for better rates, largely because competitors were forced to hike prices to fix their own terrible combined ratios. Progressive saw that blood in the water, aggressively stepped on the gas, and poured $1.5 billion into marketing in just 3 months to capture all that shopping momentum.
But here's the kicker. They aren't just throwing money everywhere. They're being highly surgical about it. Through a strategy they call Blueprint for the Future, they are actually pulling back in personal property markets where unpredictable, volatile weather creates way too much risk. They are actively reducing exposure in catastrophe-prone areas and focusing hard on lower-risk properties and bundled homeowners policies. It's a really smart, targeted approach.
Which brings us to Section 4, balancing auto and property.
Before we dig into the exact breakdown, let's quickly touch on policies in force, or PIF. While revenue and income are great for tracking the dollars, PIF is the true boots-on-the-ground metric for their expanding customer base. It tells us exactly how many active policies they've actually got on the books right now.
And you can see their tactical execution playing out perfectly right here. Look at this double-digit growth, up 12% in direct auto policies,
and up 9% in agency auto. But notice how property only grew by 2%. That is absolutely by design. It's intentional moderation. They are actively pumping the brakes on property growth to manage those weather-related risks, all while letting their highly profitable auto business run at full throttle.
And boy, does that targeted growth translate to the top line. In just the first 3 months of 2026, their personal lines division brought in an eye-watering $19.6 billion in net premiums written. That's a solid 7% bump over the prior year, driven almost entirely by the massive volume of new and renewing vehicle policies.
All right, let's look at Section 5, rewarding the shareholders. This is the ultimate payoff for the people actually holding the stock. A $100 investment in Progressive at the end of 2020 skyrocketed to over $254 by the end of 2025. I mean, they have completely crushed the broader S&P 500 index. By staying fiercely disciplined on underwriting while expanding their footprint, they have created some truly massive long-term value.
But it's not just about the stock price ticking up. Progressive is an absolute cash-generating machine. In 2025 alone, they declared a jaw-dropping $8.1 billion in total common share dividends. That breaks down to $13.90 per share. And on top of that, in just Q1 of 2026, they used $478 million of excess capital to buy back their own stock. The philosophy here is straightforward. Ensure there's enough capital to support profitable growth and then hand the under-leveraged excess cash straight back to the shareholders.
CEO Tricia Griffith summed this up perfectly in her Q1 letter. She basically said that it's relatively easy to either grow or be profitable. Companies do one or the other all the time. But pulling off both simultaneously, growing your market share while holding on to elite profit margins, that is extraordinarily difficult. And yet, thanks to their advanced data models, their strict combined ratio targets, and knowing exactly when to deploy massive marketing spend, Progressive just keeps pulling it off.
Which leaves us with a pretty fascinating question to close out on. As Progressive keeps rolling out even more advanced pricing models, like their new commercial auto product model, 8.3, and as they continuously refine their risk selection with such surgical precision, what limits actually exist for them? While their competitors are busy scrambling to raise rates just to cover losses, how much more of this market is Progressive positioned to swallow up? It's something we're definitely going to be watching closely. Thanks for hanging out with me for this explainer.